Imagine being paid like 900 million rials a year for a product you didn't even deliver.
Right. Just for promising you're ready to deliver it if they ask.
Exactly. You just have to say you're ready. And this isn't, some weird accounting loophole or a stroke of crazy luck.
No, definitely not.
It's the deliberate, like highly engineered financial bedrock of one of the world's largest global infrastructure engines.
And I mean, it's a model that completely defies how we usually think about doing business.
Oh, for sure.
Because in most sectors, revenue is this daily battle, right? But when you step into the tier of global utilities and these massive sovereign energy projects, the whole objective shifts.
Right. You're not capturing daily transactions anymore.
Exactly. You're architecting decades of predictable contracted cash flows.
Which brings us perfectly to today's mission for this deep dive. We are opening up the 31 December 2025 consolidated financial statements for ACWA Power Company.
Yes. And the goal here isn't just to, read a balance sheet at you.
No, nobody wants that. We want to dissect this financial engine. We're going to figure out exactly how they make their money, where all their cash is flowing, and what their 2025 numbers reveal about the sheer cost of basically keeping the lights on and the water flowing across the globe.
And those 2025 statements are incredibly revealing, mostly because of the staggering scale involved here.
Yeah.
Looking at this is like checking the vital signs of global infrastructure itself.
So let's actually lay out that scale for you. In a single year, ACWA Power juggled the sun, the wind, natural gas, and ocean water to generate over 7.4 billion reals in top-line revenue.
It's massive.
It is. But as we're going to see today, generating billions of reals definitely does not mean a company gets to keep billions of reals.
Right. Not at all.
So to understand why, we first need to establish what they're actually selling, and, crucially, who is writing those monumental checks?
Well, at their core, they deliver three fundamental products, right? Electricity, desalinated water, and steam. But the energy sources they use to generate all that output represent a really formidable transition right now.
Because if you look at that 2025 revenue breakdown, legacy fossil fuels are still doing a ton of the heavy lifting.
Absolutely. Natural gas brought in about 2.7 billion rials, and heavy fuel oil accounted for another 1.33 billion.
Right. But then you look at the other side of the pie, and it shows this super rapid shift. Like, solar energy generated 1.86 billion rials, and wind power brought in 562 million. So it's this transitional portfolio operating across a huge geographic footprint. We're talking the Kingdom of Saudi Arabia, the broader Middle East, Asia, Africa.
But here's the thing you have to keep in mind. Building power plants in emerging markets carries very unique macroeconomic risks.
It's because you don't just flip a switch and start mailing out bills to local residents.
You really can't. I mean, if you're deploying billions in capital in these emerging markets, you cannot rely on collecting a monthly utility bill from, say, 2 million individual households.
Right, the administrative nightmare alone.
It would be impossible. And the default risk would just be catastrophic to your financing. So instead, ACWA Power sells exclusively to what the industry call off-takers.
Okay, so let's define that. An off-taker is essentially an institutional buyer who agrees to purchase the output before the plant is even built, right?
Correct. These are usually government entities, or at least sovereign-backed institutions with really robust credit ratings.
Right.
Specifically, ACWA targets ratings of BB+ and above. And just to grasp the concentration of this strategy, their financial statements reveal that just one major customer—
I saw this, yeah.
listed simply as customer A— that one customer accounted for over 1.16 billion rials in revenue in 2025 alone.
Just one customer, over 1 billion rials.
Exactly.
So just to conceptualize this for you, this isn't a retail operation. It's not like you manufacture a battery, put it on a shelf, and hope someone walks into a store to buy it.
No, not at all.
It's more akin to, building the battery factory, keeping ownership of the factory, but having a 25-year guaranteed buyer for every single battery that rolls off the line before you even pour the foundation.
Yes. And that structural guarantee is everything. By relying on sovereign or highly rated off-takers, they effectively neutralize standard consumer credit risk.
Because it's backed by a country.
Right. If you're selling power to a national grid, the likelihood of a sovereign nation defaulting on its primary energy bill is astronomically lower than the combined default risk of 1 million private citizens.
Makes total sense.
And that sovereign-backed cash flow is the exact thing that allows them to secure the financing needed to build these mega projects in the first place.
But, shielding yourself with sovereign contracts doesn't really solve the immediate problem, which is that building a global infrastructure network takes billions in upfront capital
Billions, yeah.
before a single drop of water is desalinated or a single kilowatt is generated. So let's get into the mechanics of how they operate, because they don't just build a plant and hand over the keys.
No, their life cycle is totally comprehensive. They develop the project, they invest the initial capital, they operate the plant, and then they optimize its performance over decades.
Right.
Consequently, their revenue streams are bifurcated. They earn money through energy output services, which is the actual payment for the electricity or water delivered.
The actual product.
Right. And also through long-term operation and maintenance contracts. But the critical lever in their financial stability, the real secret sauce, is the capacity charge.
Okay, let's unpack this capacity charge, because the financial notes show they collected over 900 million rials under these arrangements.
Yeah, it's a huge number.
And they are essentially being paid that money just for having the plant ready to operate, right? And regardless of whether the off-taker actually draws any power or water that day?
Yes. Think of it like an infrastructure retainer.
A retainer, okay.
Right. Governments need absolute certainty when it comes to grid stability. If a severe heat wave strikes and air conditioning demand just surges across a nation, the grid cannot fail.
Right. People would riot.
Exactly. So the government pays ACWA Power this substantial capacity charge just to ensure that the plant is sitting there, fully maintained, idling, and ready to ramp up to maximum output the exact second it is needed.
Wow. So it completely detaches their baseline revenue from the unpredictability of daily demand.
Exactly.
They aren't sitting around worrying about whether it's a mild Tuesday and nobody is running their AC. That capacity charge covers all their fixed costs and, critically, their debt repayment.
Right, which leads us perfectly into their financing structure.
Yeah.
The balance sheet relies heavily on what they call equity-accounted investees.
Yeah, let's pause there. For anyone listening who doesn't work in corporate finance, we need to clarify what that actually means for ACWA's day-to-day operations.
So an equity-accounted investee basically means ACWA Power doesn't own 100% of a project outright.
Okay.
Instead, they form a joint venture or a project company, what's often called a special purpose vehicle, or SPV.
An SPV, right?
Yeah. ACWA takes a significant equity stake, say 20 to 50%. And this gives them a seat at the table, gives them operational control, and a share of the profits.
But they don't take on all the risk.
Exactly. From an accounting standpoint, they don't have to absorb the entirety of that massive project's debt onto their main corporate balance sheet.
So it compartmentalizes the operation, and that ties right into their use of non-recourse debt. I want to walk through the mechanics of that, because looking at this, it seems like literally the only way a company could survive building dozens of billion-dollar facilities at the same time.
Oh, it is. Non-recourse debt is the absolute engine of project finance.
Give us an example of how that works.
Okay, let's say ACWA's joint venture builds a massive new desalination plant. The SPV borrows $1 billion to finance construction.
Okay.
Because it's non-recourse debt, the lenders agree that their only collateral is that specific desalination plant.
Ah, I see.
So if that specific project encounters some catastrophic failure and goes bankrupt, the banks can seize the plant, sure, but they have absolutely no legal recourse to go after ACWA Power's main corporate treasury.
Or any of their other successful plants.
Yeah,
So it establishes a series of, watertight bulkheads across their entire portfolio.
That's a great way to put it.
Yeah, a failure in one specific geographic project just cannot sink the broader corporate ship.
And that structural insulation is the exact thing that allows them to confidently take on the vast leverage required to build tomorrow's infrastructure.
Okay, so with that foundation established, let's dive into their actual 2025 performance, because the top-line revenue experienced a really formidable surge here.
It really did.
In 2024, they reported 6.3 billion rials. In 2025, that figure jumped to 7.41 billion. I mean, a leap of over $1 billion rials requires a significant catalyst.
Right. And the primary catalyst here was a structural explosion in their renewables segment.
Okay.
Revenue there accelerated from 1.43 billion rials in 2024 to an impressive 2.42 billion in 2025. Yeah, we are seeing a direct financial reflection of their huge project pipeline coming online and really capitalizing on this global macroeconomic shift toward green energy.
Right, but, and there's always a but with these financial notes.
Always.
Combing through the accompanying notes reveals a slightly more complex picture behind that billion-rail leap.
It wasn't solely driven by selling more solar power.
No, it wasn't. A substantial portion originated from a category broadly labeled other operating income.
Right.
And that category aggressively spiked from 529 million rials to 1.30 billion.
Yeah, and when you isolate what actually constitutes that other operating income, you uncover two major non-recurring events.
But one-offs.
Exactly. First, there was a 318 million rial settlement with an EPC contractor, that's the engineering, procurement, and construction firm, and that was due to project delays.
Okay.
And second, they recorded a 246 million rial insurance claim related to historical plant performance issues.
So it's basically the corporate equivalent of getting a massive promotion at work, but also finding a winning lottery ticket in your coat pocket on the exact same day.
Yes, that's perfectly said.
Right, because both inflate your bank account for the year, but if you build next year's household budget, assuming you'll find another lottery ticket, you are going to be in deep, deep trouble.
And the danger of that lottery ticket, especially for a publicly traded company, is that if an analyst just glances at the top-line revenue, they might mistakenly model out a sustained 15% growth rate for the coming years based on a payout that is literally never going to happen again.
Right. You have to separate the signal from the noise.
Exactly. The structural shift toward renewables is tangible, long-term operational growth. But the contractor settlement and the insurance payout, those are temporary infusions.
They provide real cash to deploy right now, but they completely obscure the core operational growth rate.
They do.
And that distinction becomes glaringly obvious when we move from the top line down to the bottom line.
Oh, yeah. This is where it gets interesting.
Because with revenue jumping by over 1 billion rials, aided by those massive settlements we just talked about, the logical expectation is that net profit would surge proportionally.
Right. You'd think profit would go to the moon.
But it barely moved.
It was virtually flat. Net profit nudged from 1.98 billion rials in 2024 to 2.06 billion in 2025.
This is the paradox of capital-intensive infrastructure, isn't it? They increase their revenue by 1 billion rials, yet they are running significantly faster just to stay in the exact same place when it comes to profit.
That's the reality of the business.
So to understand where that revenue evaporated, we have to look at the drags on the bottom line, starting with impairments.
Right. In 2025, they absorbed a severe 404 million rial impairment loss.
Ouch!
Yeah, and this was primarily driven by a reassessment of generation capabilities at a specific plant. It was directly tied to an issue with a molten salt tank.
Okay, let's actually ground this molten salt technology for you, the listener, because it isn't just some arbitrary piece of metal equipment. It is essentially a giant thermal battery for the grid, right?
Precisely. So in concentrated solar power, you use these vast arrays of mirrors to focus sunlight and heat up salt until it literally reaches a molten state.
Right.
And the physics of molten salt allow it to retain immense thermal energy for hours and hours.
Which solves the whole intermittency problem of solar power.
Exactly. It allows the plant to use that stored heat to generate steam and keep spinning the turbines long after the sun has set.
But maintaining a highly corrosive substance in a molten state creates immense thermal stress and just wild engineering complexities.
It's bleeding-edge engineering.
Mm.
And when that technology fails, or even when real-world performance just degrades compared to the original financial models you drew up, accounting standards dictate that the company must write down the value of that asset.
They have to take the hit.
They do. They likely had to commit fresh capital to rebuild or replace the tank, which required them to fully impair the old one.
And that action alone wiped 404 million rials straight off their operating income.
Yep. And context is crucial here, too, because back in 2024, they actually recorded a 91 million rial impairment reversal.
Oh, wow.
Yeah, which artificially boosted their profit that year. So the year-over-year swing on impairments alone, it's just brutal.
So beyond the technological risks, there is also the macroeconomic environment to consider here. Financial charges, which is just the cost of servicing their debt, increased from 1.33 billion rials to 1.47 billion.
It's a big jump.
It is. How does a company that's heavily utilizing non-recourse project-level debt feel the impact of shifting global interest rates?
Well, non-recourse debt tied to long-term projects is uniquely sensitive to the global cost of capital.
Right.
While much of their debt is likely hedged, when you're carrying tens of billions of rials in project finance across multiple continents,
Yeah.
refinancing existing debt or securing new loans in a high-interest rate environment takes an immediate toll.
Even a small rate bump hurts.
Exactly. Even a marginal increase in the blended interest rate across a multi-billion rial portfolio results in hundreds of millions in additional financing charges, and that directly erodes your net profit.
Wow. We also have to factor in the base year comparison here. In 2024, ACWA recorded a 401 million rial gain from divestments, basically selling off assets, which obviously did not repeat in 2025.
Right.
Furthermore, their share of net results from those joint ventures we discussed earlier that declined from 694 million in 2024 to 454 million in 2025.
So when you aggregate all those factors together, you've got the molten salt thermal battery write-down, the elevated interest payments, the absence of the prior year's divestment gain, and the lower joint venture yields. The mystery of the flat net profit completely vanishes.
It makes total sense now.
The underlying machine is expanding rapidly, but the friction and the cost of operating and financing that machine are increasing just as fast.
This perfectly highlights why net profit, while, important, is heavily clouded by non-cash impairments, depreciation, and complex accounting rules.
Very clear.
If we truly want to understand management's priorities and the actual health of the company, we have to bypass the income statement and follow the actual cash.
Always full of the cash.
Let's look at the cash flow statement.
Right, because the cash flow statement strips away all those accounting estimates
Yeah.
and just shows you the raw vital signs.
Yeah.
In 2025, ACWA Power's operations generated a very healthy 3.69 billion reals in actual physical cash.
And generating 3.69 billion in operational cash is incredibly robust, but it completely pales in comparison to their investing activities.
Oh, it really does.
Their investing cash outflow for 2025 was an unprecedented 8.78 billion rials. They spent nearly double what they invested the previous year, which was only 4.86 billion.
They are deploying capital at a staggering velocity right now. I mean, they spent roughly 5 billion reals more on building new infrastructure than their current operating plants even generated.
Which means they have to bridge a 5 billion real chasm.
Yep.
And that requires going to the financing well in a major way.
And they absolutely did. Financing cash flows saw an 8.49 billion real inflow.
Okay, how did they get that?
Well, they secured 6.29 billion in new loans, which obviously offsets the 3.2 billion they paid down in old debt. But the real central pillar of their financing strategy here was a massive rights issuance.
Right.
That brought in 7.12 billion reals.
Let's actually break down the mechanics of a rights issuance for a shareholder. Management is essentially going to their current equity holders and asking them to double down, right?
Yeah, it's exactly the dynamic. A rights issuance offers existing shareholders the right to purchase additional new shares, usually at a discount to the current market price, before they're ever offered to the public.
Okay.
So management is basically saying, hey, we have a pipeline of projects that requires 7 billion rials immediately. You can buy these new shares right now to maintain your percentage ownership of the company.
But what if a shareholder chooses not to write that check? What if they say no?
If they pass, those new shares are still created and sold to other people, meaning the original shareholder's percentage of ownership in the company gets diluted.
It shrinks.
Exactly. It's a very aggressive maneuver. It signals that management believes their growth pipeline is so strong that they'd prefer raising equity capital, even if it dilutes ownership, rather than loading the balance sheet with another 7 billion rials of high-interest debt.
It's the ultimate indicator of a company in a hyper-growth phase. I mean, they ended 2025 sitting on 8.05 billion rials in cash and equivalents. That's up from 3.8 billion the year prior.
Yeah.
They aren't hoarding that cash just to be conservative. They are amassing a huge war chest to deploy into the energy transition.
The cash flow statement literally proves they are not content to just sit back and harvest the capacity charges from their legacy gas plants.
No.
They are actively architecting the infrastructure of the next 3 decades.
So let's sort of summarize the narrative we've uncovered in these statements. ACWA Power's 2025 financials reveal a company that is masterfully securing long-term stability. By leveraging 25-year contracts with sovereign, highly rated off-takers and securing hundreds of millions in those capacity charges, they completely insulate themselves from daily market volatility.
Absolutely.
And we saw a definitive surge in their renewable segment, confirming their massive pivot toward green energy.
Yet, simultaneously, they are really absorbing the intense friction of that exact transition.
Yeah, you see it in the margins.
Right. They are navigating immense capital requirements, severe technological risks, which is super evident in that 404 million rial molten salt impairment, and the heavy burden of servicing billions in project finance amid a really challenging macroeconomic rate environment.
So for you listening, the definitive takeaway here is that evaluating a global infrastructure entity requires looking far beyond the top-line revenue. A billion-rial jump in sales is just an illusion if it's entirely consumed by debt servicing and technological write-downs.
Right.
You have to analyze the impairments, you must understand the structure of the debt, and above all, you have to track where the actual cash is being deployed. Heavy investment outflows dictate that a company is building for the next decade, not the next quarter.
But that forward-looking strategy introduces a critical vulnerability that I think will define the next era of infrastructure.
What's that?
Well, ACWA Power's foundational bedrock relies on absolute certainty, right?
Right.
They secure these highly predictable 25-year contracts to justify taking on billions in non-recourse debt today. However, they are pivoting deeply into rapidly advancing technologies. Concentrated solar, advanced wind turbines, massive battery storage.
Yeah, tech that changes every year.
Exactly. We are entering an era where energy technology is evolving at the speed of software, yet their financial contracts are moving at the speed of poured concrete.
Oh, wow, that's a huge tension.
It really is. Think about it. If you lock in the economics of a billion-dollar solar array today with a rigid 25-year pricing contract, and 5 years from now, material science delivers a solar panel that is exponentially cheaper and twice as efficient.
A whole model breaks.
The underlying economics of the grid change overnight.
Yeah.
So the defining question for ACWA and really for the entire global energy transition is this. By executing these massive long-term contracts today, are they successfully locking in tomorrow's profits? Or is there a genuine risk they are locking in yesterday's technology?
The collision of those two timelines will be fascinating to watch unfold. Definitely something to consider the next time you turn on a tap or flip a switch.